Hello everyone, welcome back to my YouTube channel. This is Mehul Mehta. In this video, we are trying to price European option. In this video series, we are trying to price European option using three methods that are Black-Scholes method, binomial tree method, and Monte Carlo simulation method. So in this video, let's see the theoretical aspect of Black-Scholes model, and also I'll walk you through the Excel implementation of Black-Scholes model. So let's start. So what is a Black-Scholes model? See, the Black-Scholes model is basically a mathematical model which is used to price European style options. Okay, this model was developed back in early 1970s and soon became the cornerstone in the field of financial mathematics. So, Black-Scholes model. So for the time being, I'll just use BS instead of Black-Scholes. The Black-Scholes model. So, yeah. So the Black-Scholes model is a mathematical model which is used for pricing European style option. The model, the Black-Scholes model, was developed in early 1970s by two economists that are Fisher Black and Myron Scholes. Myron Scholes. And that's why we say refer this as Black-Scholes model. Okay. So basically a Black-Scholes model is nothing but a mathematical model which is used for pricing European style option. You'll also see this term, which is the Black-Scholes-Merton model, which is also said as the BSM model, which we will talk in later. Okay, so we'll cover this part also. But let's study Black-Scholes model. So what is this Black-Scholes model? It's nothing but a mathematical model, right? As I said, which is used to price European style option. So you might be thinking, I mean, why in the first place do we need to price a European option? What's even the need, right? So why do we price a European option, right? What's the need of pricing? So let me give you certain reasons, why do we basically price all these different kind of options. So let's say, so the reason for pricing European style options are as follows. Okay, the first reason is fair pricing. See, pricing European option helps you determine the fair market price of the option. This ensures that neither the buyer nor the seller are at a disadvantage and that the market operates efficiently. So the first reason is pricing European option helps helps determine the fair market value of the option contract, and it can be both call or put. Okay, so this ensures that neither the buyer or the seller is at disadvantage. So this is the first reason. Second, regulatory compliances. See, financial institutions are required to mark to market their positions, okay? And they need to ensure that they are accurately valuing the option contracts they have. So that's why they need a model in place, right? Of course, you know that in the trading book, you'll have different kind of European-based option. It can be long call, long put, short call, short call, short put, right? So regulators have said that you need to mark to market your books, right? And when you need to mark your market, what does that basically means is you need to price your positions every day. So let's say if you have entered into a call option, European call option, you need to price it. Or similarly for a European put option. So that's why you need a model in place, right? And that's why we are studying this whole thing. So if you see financial institution are required to mark their position to market and ensure that they are accurately valued. So, which often involves pricing options. So, since we are studying Black-Scholes, we will price European style options. Okay, this is the second reason why we are studying. First reason, as you know, to understand the fair pricing. Second is of course, for regulators so that we can do regulatory compliances. And the third reason is hedging our portfolios. See, there can be multiple reasons. I'm just telling you a few of them. Okay. See, let's say you hold a significant position in a particular stock, right? So to protect against the potential decline in the stock prices, you decide to buy a European put option, right? The price of these options helps you to determine the cost of the protection and also allows you to manage your risk exposure efficiently. So basically, let's say you hold a significant position significant position in a particular stock. Now, to protect against the potential decline in the stock price, right? What you will do? Potential decline in the stock price. How will you protect it? You can go for European put option, right? Put gives you the right to sell. You entered into a European put option, right? So now when you use models like Black-Scholes, right? So the prices of these options, right, helps you determine the cost of this protection. See, let's say you price the European put option and it came out to be $10. So you know that you are paying $10 for protecting your portfolio, right? So models like Black-Scholes helps you to understand what is the price of your option, which initially helps you understand what is the price of your protection because why you are entering into European put because you are trying to protect your portfolio, right? So this helps you to determine the cost of your protection. So these are certain reasons why we use models, okay, like Black-Scholes or any other model. So fair pricing, just to understand, okay, what's the fair market price? We need to, for regulatory compliances, we need to mark to market our portfolio. And of course, for mark to marketing our portfolio, we need to have a model in place so that we can say, okay, this position has this price, right? And similarly for hedging our portfolio, which basically means you are trying to understand what is the cost of your production by understanding the price of your of these European style options. So these are certain reasons. Are these clear?
Mehul, I
Yeah.
have a question on regulatory compliance.
Yeah.
So when we say we mark to market, right?
Yeah.
So we take the last traded price of the market, or do we assume the price the model has been showing?
So I guess you should be taking the current price, right? Whatever market has, and
Yeah.
you use
So
those. Yeah.
the question is like when we know like if the option contract being traded in the exchange, we'll have the
Mm-hmm.
last traded price, which we will take it for a mark to market.
Mm-hmm.
But how it works when it in the OTC derivatives like over the counter?
Yeah. So that's why if you see in over the counter, right? Because in if you see over the counter, I mean, first of all, those are illiquid instruments, right? I mean, not very
Yes,
liquid.
yes,
So that's why
yes.
models like this, which is the Black-Scholes models, come so much handy because that's the
Okay.
only way you can understand, right? I mean, if you see all the other, let's say, popular stock prices or popular stocks, I mean,
Yes,
those are highly liquid in the exchange, right? So you can basically see, okay, what is the bid and ask and understand what is the option price. But over the
yes,
counter, there is no bid and ask. It's a chain of brokers and dealers dealing with each other, right? So
yes.
that's why models like Black-Scholes, binomial tree, Monte Carlo, those comes in very handy to price all this European and American style options.
Okay. So the idea is for the OTC derivatives, we'll use the models we built
No,
to
even
mark to
for
market each.
No, even for our for even not just OTC, even for exchange, we'll use these models. See, what if let's say let's say taking an example of some stock XYZ, which is very hot because of the AI sector, right?
Okay.
It can be the
Yeah.
reason that people has pumped in so much money in that stock that it has actually become whatever the stock price was, let's say it's $500, it has gone to $2,000, right? Or let's say $1,500. But the actual
Okay.
price, what is it has is $500. So it is overvalued, right? So
Yes.
that's why we need a model in place which gives you an understanding of what is the actual fair price of this auction contract.
Okay. Understood.
Yeah. Any other question, guys? So let's see the assumptions of Black-Scholes. Assumptions of Black-Scholes model. So let me walk you through the assumption. So of course, whenever we are doing the modeling piece, the model take into consideration certain assumptions. See, if you in the world of quant finance, every model will have some or the other assumption. If you see linear regression model, right, it also has so many. I guess it has 5 assumptions. Similarly, all the models that you'll see in quant finance will have certain assumptions. So the Black-Scholes model makes the following assumption. Okay, let's see. First assumption is the option considered is European option. Okay, the option considered is European option, which means it can be only exercised at the maturity, right? This is the first assumption that the option contract considered is European. Second, no dividends are paid out during the life of the option. So we assume that, all this option of course gives some certain dividends. See, why we take such assumption is just to make the calculation look simple. Okay. So no dividends are paid out during the life cycle of the option. Third is markets are random, which basically means that market movements can't be predicted. Also, guys, one more thing is I have taken all these assumptions from Investopedia because I saw like certain deviations, and Investopedia is like the best resource what I have felt for finance up till now. So all these assumptions are taken from Investopedia. So market are random, which basically means that markets can't be predicted. Fourth assumption is there is no, or let's say there are no transaction cost. There are no transaction cost in buying the option. Okay. Fifth. Fifth is the risk-free rate and volatility of the underlying asset are known and constant. So of course, these values, the risk-free rate and the volatility, and also they are constant throughout the life. Okay, see, and last is, which is very important, the returns of the underlying asset are normally distributed. So these are six assumptions. Let's go one by one. The option considered is European, which basically means that you can only access at the maturity. No dividends are considered. I mean, this assumption was just to make the whole process easy, because dividends we see, like when you enter into this contracts, option contracts, there will be certain dividends that you will receive during the life cycle. So we make an assumption that okay, no dividends are paid out. Third is markets are random, which basically means that you cannot, market movements cannot be predicted. It's like very straightforward. There are no transaction costs in buying the options. See, we know that whenever we do this kind of execution, right, there are some price that need to be paid out. But see, always remember, all these models were built in, taking certain consideration, taking certain assumption. The assumption were taken just to make the whole calculation easy. So that's why we say, okay, there are no transaction cost included. Risk-free rate, volatility are known and constant. Last is returns of the assets are normally distributed. So this was certain assumption, and I feel if you are going for any quant finance interview, this is like very important. You should totally understand this, learn this, because this is like one question you will be asked multiple times in the interviews. So let's see the Black-Scholes formulas and understand it. What is the Black-Scholes formula? Okay. So the Black-Scholes formula for pricing European call option is C is equal to S naught in D1 minus K E minus RT and D2, where, so this is the formula for a call option, where D1 is equal to log of S naught by K plus R plus sigma square by 2 times T divided by sigma root T. Okay, this is how we say as D1, and D2 is nothing but ln of S naught by K plus R minus sigma square by 2 times T divided by sigma root t. See, only thing in d1, d2 is this sign. Here it is plus, here it is minus. Okay. So here it is, if you see plus, and here it is minus. So you can also write d2 in this way. So let's say d2 can be also written as d1 minus sigma delta, sigma square root t. This will essentially give you the same result, don't worry. Okay. So now let's understand what are these terms and what do it means. Okay. So let me write this equation again once more. C is equal to S naught n d1 minus k times E minus RT and d2. Right? This was the equation, right? So now here C is nothing but price of call option. S naught is nothing but current price of the underlying asset. So Kumar, this was to answer your question. When we are, because the stock price changes every day, right? So whenever, let's say we are trying to price the security, let's say the contract today, so we'll take today's current price.
Okay,
Okay.
understood.
Yeah. K here, which is this. So S naught is covered, C is covered. K is nothing but your strike price of the option, which is nothing but at the predetermined price you are, we discussed also in the last video. Also, guys, if you have not watched in the last video, in which I have covered the basics of call and put American European option, I highly recommend to watch that. So K is covered. Now R is what? Risk-free rate, risk-free interest rate. T is what? Time to maturity, or you can also say expiry. Okay, and this last term, which is everything is covered. This term, N term. This is considered as cumulative distribution function. Cumulative distribution function, which is also called a CDF of standard normal distribution. And that's why, people say standard normal distribution. That's why people say statistics is very important for quant finance, because every concept is interlinked. So this standard normal distribution is the one of the probability distribution that you will be taught in your statistics class, right? But let's understand each and every term. So S naught, which is the current price of the underlying asset, which basically what it means is the stock price right now. Okay, stock price right now. Okay, K, let me write it here. S is stock price right now. Okay, now I'm giving you a detailed explanation of each term. K is nothing but your price at which you can buy or sell the underlying asset. The price at which you can buy means call option, or sell put option. You can buy or sell the underlying asset. This is the strike price, right? T. T is nothing but your time to expiration. T is nothing but your time to expiration. That is the time remaining until the option contract expires, or the option expires, right? So let's say if option is expiring in 3 months, we will we'll take 3 as 3 by 12, which is 1 by 4. See, 3 months by 12 months in total, and this is 0.25. So we'll consider this as t is equal to 0.25. Also, always remember t is always expressed in years. So 0.25 years, okay. Then we have R, which is your risk-free rate. The risk-free rate is nothing but your theoretical return of an investment with zero risk, right? So this is nothing but theoretical return on your investment with zero risk, right? That's why we say as risk-free rate. And these are usually government bonds. So you will see always will take risk-free rate as government bonds. Now, the question comes into now we have a modeling choice to make, right? Here, let's say, and this is the kind of issues that you will face in real term when you try to model all these different contracts. Let's say, let's say your option contract is expiring in option is expiring in, let's say, 7 days. Let's say, yeah, let's say 7 days versus your option contract is expiring in 3 months, right? So will you use the same risk-free rate in both the cases? No, right? Because if something is expiring in 7 days, you will get the risk-free rate of 7 days. So in this case, you can basically take what? You can take treasury. So you can take 1 week treasury bill, right? And when you have an option contract which is expiring in 3 months, so you will take the risk-free rate of 3 months, which is nothing can be 3-month treasury bill. And see, these are all the modeling choices that you will have to make in your real term when you're trying to model anything. Of course, you cannot use the same risk-free rate, right? It's same as, oh, if I invest my money for 7 days versus if I invest my money for 3 months, of course, I need a different return on my investment, right? So similarly, in this case, you'll use a different risk-free rate. So, if you see here, okay, this term we missed here, volatility. Sorry, sigma is nothing but your volatility. Okay. Oh, I guess we covered somewhere. Oh no, we missed. So let's see volatility. And this is another modeling choice that you have to make. No, I guess not for volatility. Okay. So what is, yeah, you'll have to make certain modeling choices here also. So what is volatility? Volatility is nothing but, so it's nothing but a measure of how much the price of the underlying asset is expected to fluctuate over a year, right? So a measure of how much the price of an underlying asset will fluctuate of the underlying asset will fluctuate. Guys, just give me 1 second. Let me bring some. Yeah. So volatility is nothing but it's a measure. So what I'm essentially trying to do is I'm just trying to help you guys understand each and every term. Okay. So volatility is nothing but a measure of how much the price of your underlying asset, let's say the price of the stock will fluctuate. Now, if you see, there are two types of volatility. One is called the historical volatility, and the other one is called the implied volatility. And see, this is the kind of issues you will face in your modeling when you are trying to model all this, when you are trying to use all these different models. So which one to consider? Historical volatility or implied volatility, right? So before diving deep, let's understand what is historical volatility. Guys, are you able to follow up till now or are you lost?
We are following.
Okay, thank you. So what is historical volatility? Historical volatility, or people also say as realized volatility, right? It measures the past price fluctuation of the underlying asset. Of the underlying asset over a specific period, right? So basically, historical volatility is calculated on historical data, right? So you might be thinking, I mean, when should we use historical volatility, right? I mean, what are the scenarios? So question is when to choose historical volatility, right? So if you see, there are certain situations wherein you'll use historical volatility. First, when you are doing some historical analysis, so what it means is when you are performing an analysis based on the past price movement, or you can say when you are backtesting any trading strategies or building any risk management models, that's where you'll use the historical analysis. Okay. So, so when you are performing an analysis of an analysis based on past price. So what does this mean? Let's say you have an option contract which got expired in 2023, right? And you wanted to see how much, how much your difference is between the actual price versus your, let's say between your actual price versus your model price. So model price basically means by using Black-Scholes, well, what is the price you are getting versus what is the price that you saw actually in the market, right? So that's how you do a historical analysis. So you can use historical volatility in that case, or let's say when you are backtesting any trading strategy, right? Or let's say, or you are building any risk management models. So that's where you use historical volatility. Second is when you have lack of market data. See, there are certain option contracts which are traded in over the counter, right? And for those contracts, you do not know what is your implied volatility. So in that cases, you will use all this historical volatility. So when your future, let's say, when implied volatility data is not available. So that's where you'll use the historical volatility. Or when will it be not available when, or let's say for assets with limited option trading activity. So these are generally illiquid instruments, illiquid instruments which are not liquid, or you can say some those those option contracts which are traded over the counter, right? Where the market data is not available. So these are certain situations uh, wherein you use historical volatility. So now let's look at the pros and cons, right? See, pros is nothing but, of course, since it's based on actual historical data, right? So this is one of the best thing that we know that this has actually happened, right? So first thing is you are building the it on the historical data. Second is, of course, it is easier to calculate because you already know the market prices. What are the cons? Cons are nothing but uh, when you choose historical volatility, right? It only reflects past, let's say past market condition, and does not tell you about and does not tell you about the future volatility. Future volatilities. And the second is yeah, so this is like the most yeah, so this is like the major issue, which is it does not tell anything about the future volatility. So this was all about historical volatility, right? Now the second is implied volatility. So these are two type of volatilities that can be incorporated in your Black-Scholes model, right? So we saw historical was basically backward looking, in which we had the prices and we were deriving the volatility based on the prices we had. Implied volatility is derived from the market price of the option. The implied volatility is derived from the market price of the option. Okay. And this basically represents the market expectation of future volatility over the life of the option. And this represents the future volatility. Let's say this represent the market expectations of the future volatility. The market expectation of future volatility over the life of the option. So this is nothing but the main difference between historical volatility and implied volatility is historical volatility is based on the past prices, right? The past fluctuation. Whereas implied volatility is nothing but the future fluctuation that is gonna happen in your option contract. So when will you use implied volatility? You might be thinking, right? When to use implied volatility. So let's look at certain situations. First is when you need to do forward-looking analysis. See, basically, when the goal is to incorporate market expectations of the future volatility, or when you're trying to price option, so that it can reflect the the forward, or let's say the implied volatility which your option contract can face in the market. So basically, when you need to do forward-looking analysis, that's where you'll use implied volatility. Okay. Second is for trading and hedging. See, what happens is, uh, see, traders look to they want to understand what are the market sentiments and what are the expectations of the market, right? And for that, you will have to use implied volatility. See, the issue is, I mean, if the traders and the hedgers just use the historical volatility, that will not tell them what will happen in the future. But implied volatility will tell what will happen in the future. So that's why traders and hedgers in general, they use implied volatility and not historical volatility. And the third is, of course, when you need to take market driven decisions, right? So if I want to make certain decision, let's say whether to execute a contract or not execute a contract, right? So that depends, of course, depends on what are the current market conditions and sentiment, and that is gonna determine how your implied volatility will look like. So when you need to make any market related decision, that's where you look at the implied volatility. So these are certain cases when you see, when you use implied volatility in general. So moving on, what is ND1 and ND2? ND1 and ND2. So let's see what is ND1. See, if you saw ups in the up, I just wrote that ND1 and ND2 is nothing but your cumulative distribution function of standard normal distribution, right? This is what I wrote, right? So what is a CDF? If you see, a normal distribution is something like this, right? This is your PDF. CDF looks like something like this, right? So what you are essentially doing is, let's say at this point, CDF, as you know, is determined is written by this. So, so when you write something here, right? So what you're essentially trying to do is you're trying to find the probability. Okay, just to make it simple, CDF function will give you a probability. Okay, when you use a CDF function of a standard normal distribution, it will give you a probability of doing something. So what is that something? Let's see. So ND1, okay, ND1 is nothing but it is the probability that the price of the stock will be higher than the strike price. So tell me one thing, when is the stock price higher than strike price? This is in the money, right? In the money option, if you see stock price is always greater than the strike price. So what we are trying to find is what is the probability that the option contract will be in the money? Or we can always say what we at ND1 is nothing but it is the probability that the price of the stock will be higher than the strike price. Okay. So let's say if ND1 is 0.6. Okay. So what it basically means is it means that there is a 60% chance that the stock price will be higher than the strike price. Okay. So when we say ND1, see always remember normal ND1 and this term is nothing but it gives you the CDF of a standard normal distribution. And a CDF of a standard normal distribution will always give you certain probabilities, right? So in this case, when we say ND1 is 0.6, what it means is that there's a 60% chance or 60% probability that the stock price will be higher than the strike price, which basically mean that you will make profit. Okay, which is in the money, that the 60% probability that your option will be in the money. Okay, so now the term ND2, right? So what is ND2? Again, as we know, this same N, right? It is a probability. So what's the probability? It's the probability that the stock price end up will end up being above the strike price. Okay, so here ND2 is nothing but this is the probability that the stock price will end up being above the strike price. So when we say that ND2 is 0.55, what it basically means is that there's a 55% probability that you will actually make money from the option. Okay, so it basically means that there's a 55% probability that you will actually make money through this option contract, through this option contract. Okay, did you guys follow or not? So just to summarize, before you ask anything, just to summarize, ND1 and ND2 both are probabilities that help you understand I mean, those are just the probabilities, right? But okay, ND1 and ND2 are probabilities that help you understand the likelihood of an option being profitable, right? With with ND2, with ND2 being bit more, being a bit more realistic. Okay. So did you guys understand or not up till now?
Yes, Mehul.
So now is the formula clear of, okay, let me go back to the formula so that it's easy for you to review again. So in this case, right, C is nothing but the price of your call option. S naught is nothing but your current stock price. ND1, ND1 is what? Is nothing but your probability that the stock price will be higher than the strike price. K is nothing but your stock strike price. E raised to the power negative RT. So what we are doing is, this is the discounting factor. We are discounting the strike price. Okay. ND2 is nothing but the probability that you will actually make money. Okay. That you will actually make money. Okay. So now if someone asks you what is the equation, C is equal to S naught and D1 minus K E raised to the power minus RT and D2, where C is price of the call option, S naught is the current stock price, and D1 and D2 are the cumulative distribution function, CDF, of a standard normal distribution. Always remember, CDF of a standard normal distribution. And K is strike price, E raised to the minus RT is nothing but your discount factor, where R is your risk-free interest rate, T is your time to maturity. And when you be deep into D1 and D2, D1 is nothing but log of S naught by K plus R plus sigma square by 2 by multiplied by T. Sigma is nothing but your volatility term, R is your risk-free rate. So did you understood the formula or not? Please tell. Any doubt up till now? Should I take that as no?
Yeah, no doubt till now.
Okay, perfect. So this was the formula for call option. Um, just give me 1 second. Can you still see my iPad?
Yeah.
Okay. Just give me 1 second, guys. Yeah. Just give me 1 second. Yeah. So this was the formula that was used to price the call and put option. Now let me show you what are the assumptions of Black-Scholes model. And this is the last step, and after this we can directly jump on assumptions of Black-Scholes, directly jump on the modeling piece. See, always remember, whatever limitations are there for any model, those are nothing but your whatever assumptions you take in a certain model, the same are the limitations. Okay. So let's say the Black-Scholes model assume constant volatility, right? See, we know that in reality, the volatility is not constant and it change over time due to the market condition, right? We know that volatility is not constant and it changes with the market condition, right? So what will happen if we take constant volatility? This will give us inaccurate pricing of European options. So this is the first limitation. Second, we assume We assume no dividends. See, even though we say like no dividends, but we know that if you see any option contract, it will give you dividends. So when you take certain assumptions like this, there are chances of inaccurate pricing. See, every limitation will lead to inaccurate pricing only. Okay. So we know that it assumes no dividend, but in reality, we see dividends, right? So this is the second limitation. Third limitation is constant interest rates or constant risk-free rate. See, let's say you have taken an option of, let's say, six months, and the Fed has increased the interest rates, or let's say the Fed has decreased the interest rates. So, so even though you have taken this assumption that your risk-free rate will remain constant, but this is invalid, right? Because now the Fed has increased or decreased the interest rate in this, and let's say in this any of the month in these 6 months, right? So what will happen? This will again lead to inaccurate pricing. So sometimes taking the assumption of risk-free rate can be dangerous because it can or cannot be constant. And also you see daily also, I mean, it changes, right? The risk-free rate changes daily also, right? So this assumptions of taking it constant is like little inaccurate. Fourth is, fourth limitation is we can only price European style option. See, the thing is the Black-Scholes model is designed for European option, which can be only exercised at the expiry, right? So, which basically means that we cannot use this model to price American option or any other exotic option. Okay, Black-Scholes model can't be used to price American or exotic options. Fifth, fifth is market condition assumption. See, we assume that there are no transaction cost or it's like a perfect market, but in real we see that there are transaction cost, and we do see friction in the market. So this condition gets violated, right? That market condition, like it assumes like there are no transactional cost. There are no transactional cost, but we know that there are transaction costs. Whenever you execute an option contract, you need to pay to the you need to pay for the transaction you are doing. So this is again one of the limitation, right? Also, one of the limitation is on the assumptions of log normal distribution. So so log normal distribution of stock. See, the model assumes that, okay, one more thing is when someone says log normal distributions of stock or normal distribution of returns, it is just the same, okay? Don't get confused here. So we assume that the stock follows log normal distribution, right? And when we say it follows log normal distribution, what we are assuming here is that the stock will not exhibit jump, right? Or any kind of discontinuity. But right, in real, stock prices can experience sudden jump or crashes. So that's why this assumption is little, shaky. So, so that's why it can also lead to inaccurate pricing. Also, you know that log normal distribution comes into the class of continuous probability distribution, right? And in continuous probability distribution, we assume that there are no jumps or there are no discontinuity. If we want to assume jump or discontinuity, we need to take in discrete probability distributions. So that's why you see like this assumption gets violated. So these are certain limitations of using Black-Scholes model. So this was for this recording. Do you have any other doubts up till now in this part?
Mehul, I have a question.
Yeah.
So, the last part where you
Mhm.
mentioned the log normal distribution, like, can you give me an example, please?
Okay, yeah. See, the thing is,
Like, yeah.
yeah, see, the thing is, what happens is it assumes stock price, it goes like this or I mean, okay, wait. What it assumes is when we say like that okay, give me a better example. Wait. Okay, so when we say that, okay, this is your stock price at time t is equal to 0. So what I mean by jumps, let's say you see sudden, the price has increased this, right? This is what we consider as jump. So when you take into consideration log normal distribution, right? It does not consider this jump part. It misses on this jump part. It does not, because see the assumption of all this continuous probability distributions are that these are continuous in nature. These are continuous in nature, right? These are continuous in nature and are not discrete and are not discrete. So what does discrete means is if you see sudden jump like this, or going like something like this, these jumps are not allowed in log normal distribution. So but we know, like, I mean, there have been situations wherein the stock price has suddenly gone up and suddenly gone down. So these kind of situations are not captured by log normal distributions. Also, if you see in general normal distribution, if you see there's one, we say that returns follows normal distribution. Now, if you see the this is a bell shape. This is how a normal distribution look like, right? This is how a normal distribution look like. Now, if you see the tails here, normal distribution we say that normal distribution have thin tails. If you see here, it goes very close to the axis. It goes very close to the axis, but not goes to 0, but it goes very close to the axis. So we say that the normal distribution has thin tails. Okay. So what happens is whenever there are big fluctuations. So when there are big fluctuation in your prices, right, in your stock prices. So for those kind of big fluctuation, there are other distribution like the student T distribution. Okay, the student T distribution has fatter tails. So when you have fatter tails, it is able to uh, take into consideration the bigger fluctuations that happens in your tail. So the fluctuation, I mean, if you see here, it won't be able to capture the bigger fluctuation or the jumps that you see. That's why we take into consideration other kind of distribution like student T distribution, variance gamma distribution. So this is, and also if you see value at risk model, right, in which if you see the variance covariance method, right, Janul, we assume that the returns follows normal distribution, but one
Right.
of the limitation was returns might or might not follow normal distribution. Why? Because if there are more higher losses, we know that whenever you see higher losses or let's say higher decline in your stock prices, uh, your normal distribution will never capture that because it has thin tail. So it is not gonna capture the heavier or the higher fluctuation or the heavier losses. That's why we need to use this distributions which are fatter tail.
Okay, got it, Mehul. Thank you so much.
Yeah, did that answer your question?
Yes, it did. Yes.
Okay. Any other doubts you guys have? Okay, so so I'll take that as no, and let me stop the recording.